everybody. Mathew Owens with the Masters of Real Estate YouTube channel. I am a full-time real estate investor and a CPA here to come and talk to you and give you tips and tricks about different strategies to invest in real estate. And today I'd like to talk to you a little bit about syndication investments and how do you find the right deals to invest in. There's so many deals out there with different strategies that people deploy, different operators, and different ways to invest your capital. How do you know if you're gonna lose your money or not, or if it's gonna turn out to be a good deal or a bad deal? And how do you do the right homework on these deals so that you know that it is going to perform long-term or has the highest chances of doing that? So most of the time in syndications, you are giving up control over your investments to invest with an operator that focuses in that asset class, whether that's self-storage, mobile home parks, retail deals, promissory notes, single family homes, multifamily, all the different types of strategies that are out there that different operators specialize in. And there's things like ATM machines you can invest in. There's Bitcoin mining funds. There's all kinds of different, categories even outside of real estate that you can focus on as well. And so how do you pick the winners? How do you know which ones are the right ones? And it comes down to doing the right due diligence to mitigate those risks. It's always a risk that something could turn out bad or something could happen with that particular deal, or a million other risks exist with any particular investment in real estate. And I really like syndication investments because you can diversify into multiple asset classes, multiple markets around the country, and multiple operators as well, with smaller chunks of money to mitigate risk even further from issues coming up. But how do you choose which ones to invest in the first place? And so it kind of comes into like three different primary categories, and there's some other things that need to be done, of course. But the first thing to do is to do your due diligence on the operator that's doing the deal in the first place. So what does that mean? That means proper criminal and background checks on those operators. That means talking to their team and their operations team on the ground to find the right things that they're doing, and right understanding of what is their processes and their systems and their checks and balances look like. What does their experience look like as well with regard to that specific asset class or that niche that they're in, and really diving in deep into who they are as an operator, how they think. Do they think conservatively? Can you get investor references from them? Can you understand the way they analyze assets and the way they analyze risk to see if they have been able to mitigate those risks in the right way? Okay. So that's the first thing, is the operator due diligence in the first place. Then it comes down to the actual deal and the structure of the deal and all of that type of workload that you have to do the right due diligence on those things. Meaning you're going to be looking at, hey, are there preferred returns involved? Which means that me as an investor, I get paid first before the operator is doing the work gets paid. So there's incentive for performance there. Is there a massive amount of upfront fees built in that really take away that incentive for performance up front on the deal, where people sometimes are just motivated by fees? It's okay to pay for some of your costs associated with this and the time and labor to get this whole thing set up. But when it comes down to massive fees, you want to make sure they're not weighted in the wrong direction. You also want to understand some of the key due diligence associated with the documents as a whole: the private placement memorandum, the operating agreement, the executive summary. Understanding those things and the provisions within the document are absolutely key for being able to be successful at this. And, understanding the debt stack on the deal. Where is the risk associated with the debt? What other risks are you seeing with that specific investment that you can mitigate or ask questions about that you see based on your experience? And if you are not sure about what risks exist, go get an outside financial person or financial advisor or someone that focuses specifically on investing in syndications to kind of point out maybe some key risks that they may see with the overall investment. Maybe it's the market as a whole that they're investing in, and they're more of a tertiary market or rural market or something like that. Maybe it's the tenant base or the asset class or the asset in particular in that market with supply and demand. So there's a lot of little things that go into analyzing that deal as a whole, so you can see what's happening with the deal and the overall metrics of the deal and the paperwork involved and things like that. And then the last thing that I would absolutely focus on is that financial model, the financial assumptions associated with the deal, understanding, hey, are they pretending like rents are going to keep going up by 30% a year or 20% a year, or even 5% a year may be very aggressive right now? And are they saying that expenses are going to go up at the same, a higher pace or lower pace? One way that a lot of operators make numbers look better than they really are is by increasing rents by a certain amount and increasing expenses by a little bit lower amount so that the cash flows get higher over time. And so you want to be very careful and make sure that, you know, they're at least at the very minimum even on that. And with inflation happening and that type of stuff, always very, very key. Understanding, hey, what kind of renovation are they going to be doing on that project? What does that debt look like? Are they getting short-term debt in the deal and then refinancing afterwards? What about that refinance risk over here upon refinance of that deal? A lot of investors that are in operators, they'll go get short-term bridge debt and then refinance into long-term debt, versus sometimes they will go through and get the long-term debt up front and put up a little bit more capital to counterbalance for that renovation that might be needed, or the value add component of that if it's not a major value add component. So, you know, understanding the financial assumptions, their vacancy rates, their appreciation rates, their expense increases, going over every expense line item and every revenue line item and asking the operator, can you show me the backup? Can you show me the backup of the market rents that you're saying you are going to get for that property and those actual comparables, so that I can determine, do I agree with you on those market rents? Do I think that you're accurate or being aggressive? Or maybe you're pricing your model where your financial model where you're being conservative and lowering the rents even compared to what you really think market is. That's what you're looking for in detail, is that conservative approach to that financial modeling and going over every expense category to make sure they didn't miss something, or something that they can't answer or becomes a bigger risk for you personally that you're just not comfortable with. And so, you know, these primary things: vetting the operator, vetting the overall deal and the structure of the deal and the paperwork involved in that deal, and the market as a whole, and then vetting the actual financial model and the exit strategies involved to make sure that you have all three of these categories covered. And there's obviously some additional things you want to be doing, and flying to the market to check out the property, doing that type of stuff, or having somebody else do that for you. There's a million other little things, but as an overall picture, as a summary, those three things are key to being able to pick a very good or very bad investment out. There's plenty of deals that I have not invested in on purpose because they didn't pass those types of tests. They didn't pass the break-even analysis on the financial analysis side based on the risks that I saw with the overall investment as a whole. So I hope this helps, giving you a little bit of clarity on how to pick the right winners and losers with regard to syndication deals and being able to make those right decisions. But it's always great to diversify with smaller chunks of money across multiple operators so that you're not taking too much concentrated risk on one operator or one deal or something like that. So very important to kind of focus on. So I hope this helps. If you guys like the content, please like, subscribe, hit that notification bell. I will be coming out with content like this for you guys on a consistent basis, just to help every way I possibly can and add value any way I can. Thanks so much, and I'll talk to you guys soon.